Dr. Ayodele-Bamisaiye of Dexteritas Professional Corporation. It's always a pleasure for me to come to you every Friday morning like this to talk about all things personal finance and enterprise. It's been an amazing week. The weather in Calgary is nice and warm. Snow is gone finally. Yes, I know I'm mentioning the four-letter word that we all love to hate. But yeah, it's been nice and toasty all week. And it looks like the weekend is set for bike riding playground weather. And with that in mind, I'm making a brief detour, a brief pit stop from my regular conversation today. And today I'm talking about taxes. As many of you know, I have an office where we prepare loads of personal tax returns. And I also volunteer with a not for profit that does the exact same thing. And because of this, I have seen quite a number of tax returns in my time. Today, I just want to talk about 5 common errors that we see in personal tax returns. And if that does any good for you, then I'm happy. And if it doesn't, I just take it in the chin as another Friday morning conversation. Before we get into the meat of that matter, I wanted to bring it to the attention of my modest income friends that if for any reason your personal income is less than $50,000 as a household and you have not filed your personal tax return, whether it's 2025, 24, 23, 22, 21, 20, 19, 18, you get the idea. Whatever duration is, if you need support with this, you can reach out to my friends at the Financial Empowerment Initiative. Send an email to taxes@thefei.ca and somebody will reach out to you with a time and a date when this can be taken care of. Our virtual tax filing services are available, and the first of them will be happening on June 5. To my knowledge, all appointment spots for that day have already been booked. So just stay tuned, check out the FEI's website, and if you, for any reason, you haven't filed your personal tax returns yet and you are modest income, they will be more than happy to set up an appointment for you to get that done. So that's number one. Startup Court's Founders Lounge for the month of May was a brilliant success. I really want to thank Craig Elias for his support leading the Plain Lean session that we had. That was a very good one. I had so much fun just being in the room watching seasoned entrepreneurs and student entrepreneurs like Darren and Christabel, seeing them make decisions together on whether to sell more, hire more, experiment more. That was just a blast. I had fun doing that. And I specifically want to thank Bruno Pesek from Oslo for his support making this session happen. I also want to thank my friends at the Bow Valley College who ensured that we had the copies of the game enough for the night to play. Stampeak, I see you. Thank you very much. That said, I am going into the meat of today's matter. 5 common errors that I've seen with personal tax returns over and over and over again. How often does it happen that after filing your tax return and getting that healthy refund that you are so excited about, you suddenly get another letter in the mail saying your tax return has been reassessed? Yes, heartbreaking. Now they're asking you to pay back some of the refund that you got. Why? This happens a lot of the time because the CRA has received some slips that you did not see or you had not seen as at the time of your filing. And as a result of those slips, they have reassessed your tax return and they've assessed you to more taxes. So yes, the first error, one of the most common errors I've seen is missing slips. T5s from banks or financial institutions, T3s, T4PSs, profit sharing, bonus related documentation, T4As from places where you contracted, those kind of things, tuition slips, which may put money back in your pocket actually. Yeah, those kind of things sometimes get missed. So it's important for you to, when you are preparing your tax return, to be beyond looking at the slips you have, to say, hey, what has happened in my life in this year, and does it have a tax implication? When you make that kind of judgment, it's easy for you to say, hey, I'm missing this slip or the other slip, and based on that, you can go after them and get them and make sure your returns are done right the first time. That's number one. Actually, that's number 5 on my list. Now, counting down, number 4 is missed credits and deductions. So, for example, you buy a new house, brand new house, and as a result of that, you are entitled to the home buyer's amount, 15% of $10,000. For some reason, while you are preparing your tax return, it doesn't occur to you that there's a credit for that, right? So you miss a $1,500 refund because that's a credit, and that's basically a reduction in your tax bill for the year. That's not the kind of thing that you want to miss. Medical expenses, charitable donations. You made the donation, the slip didn't come in the mail. Or the slip came in the mail and you mislaid it. And as a result of that, you're like, I can't find the slip, so therefore I'm not going to claim it. That's just dollars out your pocket. It's unnecessary. So be aware of what has a tax implication in your life, and get the documentation to ensure that you can make the claims for the deductions and the credits that are relevant to you. Now, the funniest one of them all, actually, which is number 3, is treating your tax refund like it's some big financial win. Hello, it's a refund. A refund means you paid money, and then the person you paid the money to decided that money was not theirs to keep, so they gave it back to you. So a tax refund simply means that you've paid too much to the government in taxes. That's money that could have been invested, that's money that could have covered some historical bill that has now devolved into a less pleasant situation. And it now comes back in a refund, and you're like, yay, I got a refund. Hello. That doesn't speak to excellent personal financial management. It speaks to you letting other people hold your money without giving you anything back. So, a tax refund is an event. Wealth building is a system. Don't plan for a tax refund. Plan to pay all the taxes due and put your money to work to your advantage. That's the deal. The next one, which is number 2 on my list, is waiting too long to ask for help. Hi, all my incorporated contractors out there. All my real estate investors out there. You sold the property and you're like, oh, so by the way, I sold 2 properties this year. What are the tax returns? No, that's not how it works. Why? Because taxes are pervasive. They impact your investment, impact your earnings, impact your write-offs, impact your retirement planning, impact your estate planning after you're gone. So if you're not thinking about your taxes that way, you are always going to make the wrong decision when taxes are an afterthought. So please, if you're a real estate investor, before you sell another property, consult your accountant. If you're a business owner, you're considering transiting from incorporation, from sole proprietorship to incorporation, or vice versa, talk to your accountant. If you are receiving CRA letters, consult somebody and get clarity. Some of them are simple and easy, particularly the ones that say, hey, we want to see your donation slips, or we want to see your tuition slips. But some of those letters are not that straightforward, so it makes sense to talk to somebody that understands how these things work better. So please, I want you to know this. Tax problems are easier to prevent than they are to solve. We are always better off when we envisage it and prepare for it in advance, rather than when we are trying to fix it on the back end. So, right now, I'm going to head to the most important, the number 1 mistake that I've seen across income levels. Low income, middle class, HNIs, I've seen this over and over and over again. I know you want to know, right? Yeah. And that is tax planning. Hello. If you do not plan for your taxes, you will always overpay. That's the fact. Your tax filing is an February, March, April appointment. Your tax planning runs for the 12 months from May for 11 months, from May all the way till March. And why is this important? Like I said earlier, your taxes impact the entirety of your financial life, from earning all the way to legacy. So if you are not planning your taxes, you are always going to be overpaying. Planning impacts your RRSP contribution strategy. It impacts whether you choose to incorporate or remain a sole proprietor. It impacts whether you are splitting income with a close family member. It impacts your investments, your capital gains, as well as your retirement. I can't emphasize tax planning enough. So if you think you do not need to plan your taxes, irrespective of what income level you are wrong. Let me give you a quick example. A recurring challenge we experienced at the tax clinic was individuals who earned less than $50,000 and still had to pay taxes to the CRA. That sounds incredulous, right? But this happens a lot more frequently than we would like to acknowledge. Why is this the case? When a low income individual or a modest income individual works 2, 3, 4 jobs where they are earning less than $15,000, each of those jobs assesses them to tax as if they are earning $15,000 all in. But when you earn $15,000 from 4 places, suddenly you are a $60,000 earner. The income taxes on $60,000 or $50,000 are significantly different from the taxes on $15,000. And as a result of this, a lot of hard-working, modest income individuals find themselves in a situation where they're having to pay taxes out of the cash that they're struggling to earn. And this is because there is no plan. And the advice I always give them is, if this is going to continue to be your situation, then ensure that you are either setting aside the money or requesting one of those employers or 2 of those employers deduct a bit more in taxes. That ensures that at the end of the year, you've paid enough to cover your actual income and not what they perceive to be your income. That's the spiel this morning. I just want you to realize this in closing. The interesting thing about these 5 mistakes is that only 2 relate to when you're filing your tax return. The other 3 are pervasive and they can be addressed anytime in the course of the year. The best tax outcome is not created by software. It is created by the decisions that you make starting in May and running all the way till when you file that tax return. My name is Ayodele-Bamisaiye. This is Finance Friday and it's another beautiful day. I hope you learned a thing or 2 from this. And I hope if you did, kindly share it with somebody else. That's all I got for you this morning. Have an excellent Friday and a great weekend ahead. It's bye for now.